Hello, magandang araw sa inyo, dear students. It's been a while. I think we are all very much excited to continue our discussion when it comes to valuation models. Previously, we have discussed about bond valuation techniques. So this time, it's going to be a two-part discussion series. No, this is going to be the first part, and the second part will be uploaded after this. Simply because napakahaba ng ating pag-uusapan for this topic, ano. Actually, the CFA curriculum has an entire book provided for equity valuation techniques alone. So what I did, I just simply handpicked the most important topics that you as finance majors should be familiar at this point in your course. So without further ado, let's begin with the presentation outline, the summary of our discussion. So kung titignan nyo, napaka-konti lang nitong content natin, but it's really very substantial, no? So per topic, per equity valuation model, no, napakarami nating pag-uusapan. So first, we are going to define, no, bakit napaka-importante nung salitang estimating. Now, we've been doing so much estimation since we started the bond valuation topic. Everything is mere estimation, you know. But we are going to discuss the different values that we use in stock valuation and the difference to the market price. And then next is we're going to discuss in detail, no, the major categories of equity valuation models, which are the present value models. This is not the first time that you will be hearing this because ever since we have discussed the bond valuation topic, we already discussed why present value models are so important when it comes to deriving value of investment assets. Okay, and then next is the multiplier models. This is going to be the first time that you will be hearing this, most likely. And then next would be the asset-based valuation model. So I just handpicked these three. There are other models that are being discussed in other finance books, but I only selected these three. And then the last part, we will be discussing the advantages and the disadvantages of each of these valuation models or techniques. Okay, so itong ginagawa natin ngayon, it falls under the umbrella of fundamental analysis when it comes to investment management. Okay, so under pa rin siya ng fundamental analysis. In fact, in my investment management class, we are doing quantitative analysis, which is still under the umbrella of fundamental analysis. Okay, actually, itong ginagawa nating equity valuation and bond valuation is the how do you call this? It's actually the last level, ano? So kung meron tayong inverted triangle, meron tayong the biggest picture, which is the macroeconomic analysis followed by industry analysis. The last part of that stage is actually stock selection, which is what we are doing right now. Okay, when we say fundamental, kasi it's the core, it's the most important. It's something that is absolute, something that can be computed, something that can be researched and can be proven right because you can form conclusions and hypotheses. Okay, so fundamental analysis is basically, it has something to do with looking into the quality of the company growth in terms of earnings. Okay? So since kanina nabanggit ko na yung macroeconomic, we also take into consideration the GDP growth of a particular country. And also, kanina na nasabi ko yung industry and company analysis. That's why you also have to take into consideration, is the trend that is happening in the industry itself. Ano? So, titignan mo rin yung industry growth. So, after taking into consideration this 3 specific characteristics or traits, no? Itong pinag-uusapan nating quality of company growth in terms of earnings, actually dito magfo-focus or dito mas nakasentro yung usapin natin in terms of equity valuation. Okay, so since kanina, sabi ko, we're gonna talk about estimating value and market price, ano? The word value, we would want to, again, reiterate the meaning of value. So, kung titignan natin dito, no? Sabi niya, in fundamental analysis, the value of a security is estimated using information about investment fundamentals. So, ito nga po yun. And then, the estimated value is compared with the market value to make investment decisions. Okay. Now, what we are trying to look is the fundamental value. The fundamental value of an asset as compared to its market value. So therefore, sabi niya, the estimated value is referred to as the fundamental or intrinsic value of a security. I think I've already mentioned this during our bond valuation discussion, but again, it is the same concept that we apply in security valuation or in equity valuation. Again, let me just read this. No, it's an estimated value. It's not. It didn't say that it's an absolute value. So, pag sinabi mong estimate, it's a forecasted. No, it's something that you get through mathematics, statistics, regression, etc., etc. Ano? Okay. So again, once you apply this fundamental characteristics, you derive the word or you derive the equity's intrinsic value. So without doing so, you are just merely speculating the value of a firm. But the bottom line of what we are trying to say here is we would want to look into the intrinsic value versus the market value, because the market value and the stock market as it is, is being pushed and pulled by the demand and supply of a particular stock. So sometimes nagkakaroon ng misvaluation in the market simply because sometimes people are just merely speculating without any basis of that speculation. Sometimes sinabi ng kaibigan mo, it's good. Sinabi ng mga brokers, it's good. But if you truly examine that stock, hindi naman pala yun ang sinasabi niya. So as future investors, as future stock traders, what we want to know is, are we just following the flow of the people? No, what we want to achieve is that we want to know the real value of a stock so that we can make sound investment decisions from that data or information. So before we proceed further into the video, since we're gonna talk about intrinsic value, I would want to share a short clip with you. So panoorin nyo muna and let's see what we can learn from this after watching it.
Supreme, baby.
Just bought a faux fur jacket for $1,000. So
People want to know, hey, look, that guy's wearing Supreme. But people also make a living off it too, so.
These two jackets are nearly identical. Both made by the North Face and both using Gore-Tex technology. This one on the left costs $300. The one on the right is currently selling for nearly $1,300. So what's the difference? This one just happens to be a North Face collaboration with Supreme. So why would someone pay nearly $1,000 more for basically the same jacket? And what is it that makes Supreme so expensive? From the eye-catching logo to the limited product releases and artist collaborations, over the past 20 years, Supreme has transitioned from a small skateboarding store in New York to a $1 billion streetwear company. But for its fans, Supreme is more than just a brand. It's often an obsession and an entire subculture of its own. Since its origin, Supreme has maintained an image of being authentic. Founded by James Jebbia in 1994, Supreme started as a skateboarding store in the Soho neighborhood of Manhattan. The store started out selling hoodies and sweatshirts aimed towards the burgeoning New York skate scene. Throughout the 90s and early 2000s, Supreme functioned as a skate brand, catering to both skaters and those interested in the emerging streetwear style. But Supreme's limited releases and attitude has pushed them far beyond their beginnings. The most iconic Supreme design is their box logo. Originally, simple white italic lettering over a plain red background. This design so closely echoes the work of conceptual artist Barbara Kruger that it's hard not to see it as a direct copy. And copyright theft is something that's in Supreme's DNA. Supreme's appropriation of images is one of the keys to its popularity. Pop cultural imagery and logos are copied and adapted in a way that makes their designs feel more like contemporary art or graffiti than a big fashion brand. Supreme's first branded t-shirt was simply a photo of Robert De Niro in the film Taxi Driver, along with the iconic red and white logo. And the company's use of often unlicensed imagery has led to Supreme being served cease and desist letters from Louis Vuitton, the NHL and the NCAA.
The more we're being exposed to a brand, the more likely we are going to be developing an association, a familiarity, almost a sense of connection with it. With Supreme, there's no elements of status, and they went completely for what a logo should be all about: standing out, being identifiable.
The recognizability is key to Supreme's power as a brand, but the items are also purposefully difficult to get a hold of, and their products are kept in high demand by very limited releases.
Tuesday at 11 a.m. you go to the Supreme website, you enter your basic information, your name, email, phone number, and credit card number. Then they'll send you a text later in the day to let you know if you've been selected to stand in line. Then on Wednesday, they'll send you a text telling you the time and store to report to. And on Thursday, you go to the store at the time that you're given. There's a one limit per style rule in Supreme. So what that means is if a shirt comes out in black, red, and gray, you can only get it in gray. So if I want it in black and red, I need to get 2 other people to get it for me. So they need to stand in line for me. A lot of the people who do stand in line are standing in line for someone else.
Supreme only sells their merchandise at 11 brick and mortar stores across the world, as well as their online store. It was around the mid to late 2000s that Supreme really started to pick up speed. This success was partly due to what's been dubbed the Kanye effect. In 2006, Supreme released their Supreme Blazer SB, a collaboration with Nike. The shoes retailed for around $150, with resale prices ranging from $300 to $400. In July 2007, West was pictured wearing the shoes at the Grammy Foundation's Starry Night party. After the photos were released, the resale price of the shoes doubled to $800. Similarly, the teal box logo sweatshirt worn by Tyler the Creator in his She music video, originally priced at around $150, sold for $3,500. But not everything from Supreme is going to end up being valuable. Sellers like Chris have to decide what's going to be popular and what items will give them the best return.
So how I decide on what I think is going to resell is based mainly on what I would wear. You can also go to these Instagram accounts and they'll have Instagram polls, Twitter polls, talking about, oh, like you can upvote this, you can downvote this, and it's this crowdsourcing tool to understand the market better and find out, oh, this one's gonna resell, or this one is really popular. The most money that I've made off of one Supreme item is the 2017 Fall-Winter collaboration with the North Face, and it was a mountain parka. I bought it for $398 and I sold it for $950.
This incredibly limited release means that buying and reselling Supreme items is where the real money is. When you look at the prices of Supreme items in store, they aren't as outlandish as you may expect. They retail for around $38 for a t-shirt to $138 for a sweatshirt, but it's once these products have sold out that they can reach 30 times their original price. Many other big brands are now adopting this method of very limited releases to generate hype around their products. From trainers to other streetwear brands, these releases make people feel like they're part of something exclusive.
The more we make a consumer work for a particular access to a product, the more alluring these services and products are becoming. So I think Supreme know very well how to make something incredibly accessible and sexy by allowing us to jump through as many hoops as possible to make it relevant for them.
But there's something about Supreme that's different. Could any other company get away with selling a brick or a branded crowbar? What is it that gives Supreme such a devoted following?
I think it's the hype. They come out with really cool items. I personally feel like they do. It's a name brand, and name brands attract anybody at the end of the day.
In New York, especially, it's a lot of streetwear. So like people want to have that like exclusive, those exclusive items. So I feel like Supreme, they keep their quantities very low because of the high demand. People will pay that price if it's something they like.
Supreme, I think the thing that really causes people to spend money and wait in line is kind of the it factor that it has, right? And they've done an amazing job of limiting quantities and underproducing to the demand. So in that way, their market of people that would want to buy the product isn't just people that are interested in the product, but it's also people that are interested in making money. And that demographic is way bigger than people that are just interested in streetwear. So when there's an opportunity to make money, then there's going to be a huge line of people around the block, regardless if they want to wear the product or not.
Supreme has managed to somehow keep their cool, alternative and exclusive image despite their expansion, and has still maintained its skater credentials despite selling a 50% stake in the brand to a private equity firm. With more and more people wanting their products, for now it looks like Supreme isn't going anywhere.
All right, there you go. I don't know if you guys are willing to buy a 60,000 jacket, and hindi ko alam bakit kailangan mong bumili ng isang 60,000 jacket for what? For fashion, for being being part of the trend. Kasi for me, there is so much that I can do with a 60,000 peso, no? So what I just want you to learn from that video is that, people are naturally kumbaga, we are naturally hyped by things, whether you like it or not. Minsan talaga hindi natin maiwasan na makiuso. You know what, in behavioral finance, we usually talk about the different types of investor behavior, that yung mga anomalies and mga different theories that is happening as human beings and how we react from different phenomenons, But anyway, ang ano lang dito is the legit, supply and demand factors in the market is really real. Because sometimes, the brokers themselves, they are the ones who make hypes in the market. So it's up to you as an investor, as a future trader, if you would go with the flow of that kind of hype that traders actually create. Okay? So dun sa nakita natin, pricing, napakalaki ng kinikita ng mga we call them yung mga ano bang tawag sa kanila, kumbaga parang mga kumbaga sa secondary market na kasi, yung mga resellers, that's the term, we call them the resellers. They actually make money out of hyping the prices. Kasi kapag nga naman konti yung supply pero malaki yung demand, talagang tataas yung price. And then also the role of media, the role of significant or influential people in the market. O nga naman, pag nalaman mo, si Elon Musk ay bumili ng ganitong stock, or si Warren Buffett is merong ganitong stock. So ikaw mismo, kakaroon ka ng feeling na dapat ako rin, Even right now, the rise of cryptocurrency, everyone is really they are very much speculating on the real value behind cryptocurrency. But anyway, ang pinag-uusapan natin is yung price. But there is worth, there is cost, there is price, but the ultimate core of everything is the word value. Okay? Pag sinabi kasi natin intrinsic value, this is the price that a rational investor is willing to pay for an investment given its level of risk. The thing is that the risk-return trade-off principle is really something that you have to keep in mind whenever you go into an investment decision. is this money that I'm paying for this asset worth the risk that is inserted into it? Kumbaga yung kaakibat na risk ba nitong asset na ito is worth dun sa price or dun sa dun sa cost or sa price, at ganun ba yung pinaka value na madiderive ko if I invest in it. Okay? So therefore, since we are talking about market price and intrinsic value, so here is what we call the intrinsic value analysis. Okay, so later as we progress with our discussion, ito yung ating pinaka-basis ng ating decision making. Okay, so if the intrinsic value is greater than the market price, okay, ibig sabihin, yung asset na yan ay undervalued. Ulitin natin, if you have computed that the intrinsic value of a particular jacket, no, sa ukay-ukay na lang, so since we're talking of undervalued, there was a time I was able to buy a 100 peso Uniqlo yung mga hindi pinaplansya, hindi na kailangan plansyahin. I only bought it for 100 peso. Sobrang ayos pa nung long sleeve na yun. And it's color white. I really love white polo shirts. It's so clean. Plus, you don't have to iron it. It's a non-iron shirt. So, it's only 100 peso. But if you're going to purchase it right now, sa mga malls, it's valued at almost 1,200 or 1,800. So, you know that is a good buy. Nakatipid ako kasi nabili ko lang siya ng 100. So, therefore, kung given yung condition niya, it's still good. And then with the price of 100, you know it's an undervalued. O kaya nga siya tinawag na ukay-ukay. It's an ukay-ukay price. But sometimes you really have to be patient sa paghahanap ng good buy sa ukay-ukay. So again, if the intrinsic value is greater than the market price, then it's an undervalued security or it's an undervalued stock. But if the intrinsic value is equal to the market price, no, kung titignan mo pantay yung computed intrinsic value dun sa kasalukuyang presyo niya sa market, so therefore it's fairly valued. But if the intrinsic value is less than the market price, okay, again, if the intrinsic value is less than the market price, you know that it's an overvalued stock. Okay, let's say for example that the video that I just showed you, there's this 300 North Face jacket and then nilagyan lang ng logo ng Supreme, and then all of a sudden it's $1,300 or 1,300 or it's almost 60,000 pesos. So kung titignan mo, ang value niya talaga kung wala lang yung logo, it's only 300. Pero bibilin mo siya ng 1,300. I don't think someone rational would be doing that. So the intrinsic value is less than the market price. Okay. So ang conclusion natin doon, if it's an undervalued stock, you would buy. You know that it's a good buy. Kasi in the long run, if you buy undervalued stocks right now, you have an assumption that in the next few years, tataas pa yung value niyan, no? Given that you use the correct valuation model, you would assume that in the long run, tataas yan because it's going to match the market price. Okay? But if it's an overvalued stock, no, the intrinsic value is less than the market price, you know that it's very overvalued. So the decision would be in the long run, you would sell that asset. Okay. Now, moving on, I've actually showed or nag-insert ako ng picture dito ni Justin Bieber, Ed Sheeran, Taylor Swift, and ito, dahil favorite local band ko ang Ben and Ben. Hindi pa sila Ben and Ben dito, the Benjamins pa lang sila. I wrote here, what we would want to achieve here is to have a critical eye for value and potential. So just imagine if you were the ones who discovered Justin Bieber when he was just 13 or 14, or you were the one who discovered Ed Sheeran when he was just 17, or Taylor Swift when she was just 13, and you know that they have this potential to grow as superstars or as legends in the future. Ganun din, if you try to look at that concept, what we want to achieve is how do we create a critical eye for value and potential in stocks. Okay, so the thing is, in the stock market, you can do that through these models, this equity valuation models, bond valuation models. But in terms of talents, napakahirap niyan. Well, similarly, in terms of talent, you get to nurture that. You get to create branding to those talents. So ganun din sa mga stocks. The reason why we have quantitative and qualitative analysis, because qualitative is like the nurturing side of investment selection. So kumbaga, kung pag-uusapan natin environment, kung sa stocks na we're talking about CSR, the good reputation of the firm, etc., etc. So ganun din. I hope by the end of this discussion, we get to see the beauty of looking into the real value of assets before we actually buy them, and looking into the future potential once we spot this undervalued stocks. Kasi yun naman ang palaging sinasabi ni Mr. Warren Buffett, we have to constantly look for undervalued stocks. Now, moving on, since intrinsic values are just estimates, what if the market value is not equal to the intrinsic value? What does that mean? So, since nag-estimate lang naman tayo ng intrinsic values nga natin, as I have mentioned, we're just using different models to arrive with our intrinsic value. So, if that's the case, you have to look into the percentage difference. So, gaano ba kalaki yung agwat nung na-compute mong intrinsic value dun sa current market value or market price. Okay. Then, you also have to look into the confidence in the model that you've adopted. Because as we progress later, dun sa mga different present value models natin, probably yung analyst nagkamali lang dun sa kanyang inadopt na model. So, you also have to make sure that you have to ask other analysts if they are doing the same thing, if they agree with you. Kumbaga parang kung doktor yan, same treatment ba tayo ng ginagawa based on my analysis. So there has to be a confidence in the model that the analyst has adopted. And then the next is the model sensitivity to assumptions. Later, mas maintindihan pa natin tong tinatawag nating sensitivity, because, for example, there are certain models that are sensitive to inflation. There are models that are sensitive to the phases in terms of industrial growth, Marami pa yan. Political sensitivity, GDP sensitivity. So, you also have to take into consideration the sensitivity of these models to different assumptions. And then number of analysts, probably siguro kasi konti lang yung analysts na nag-adopt ng ganitong model. So you go with a higher number of analysts who actually promote this type of models. Kumaga parang ganyan, And then will the market naturally move towards the intrinsic value? Kasi baka yung inadopt na model nung analyst na yon doesn't necessarily jive, or it doesn't complement the market movement. So maraming reason kung bakit minsan, yung mga intrinsic values din, hindi nagtutugma dun sa market value. So, ito yung mga dapat ding i-consider once you adopt different equity valuation techniques. Okay. Next is, speaking of, let me just, insert ko lang to because we're talking of investing and trading. When there are two types of investors. Okay? One is that just out of profit, yung kumbaga short-term na profitability lang. But there is what we call two types of investors. Kasi magkaiba yung trader sa investor. So there are two types of investors. Number one is the value investor, and there is what we call growth investor. The reason why we need to measure intrinsic value is because of these two. You can only derive value and growth out of purchasing undervalued stock. So investors who subscribe to the concept of value investing will not purchase stocks that are above their intrinsic value. Instead, they only look for opportunities to find cheap stocks. Okay? That's the term, kasi intrinsic value investor ka, you look for undervalued stock. But if you are a growth investor, that is the opposite. This is someone who believes that the stock is in fact not too expensive and will deliver more growth than the market expect. Okay, so sometimes you don't really have to look into the cheapest stock. You have this belief na ngayon hindi pa yan masyadong expensive. Kumbaga sakto lang siya dun sa presyo niya as compared to the future value that it can still derive in the future. So that is the difference between value and growth investing. Growth investors that doesn't really focus on the price but on the potential of that particular stock. And then we also have, ito naman, sa trading naman ito, investors don't use short and long strategies. Sometimes it's really the traders that adopt this strategy, short versus long. But I would want to insert this in our discussion since we're talking of equity valuation. Pagka manunood kayo ng news or may mababasa kayo ng articles, you would really most of the time read short and long. So pag sinabi nating when the stock is overvalued, it presents an opportunity to go short. So ito yung sinasabi natin kanina, when the stock is overvalued, you sell. So the word short in trading is also, it also connotes to the word selling. Okay, you go short on stock X or stock Y. But when the stock is undervalued, it presents an opportunity to go long. So when you say long, in the stock market jargon, it means you are buying. So short is selling, long is buying. Ang gumagawa nito, madalas yung mga hedge fund managers, they do short and long in terms of stocks. No? I'm gonna do short, I'm gonna do long for this stock. So that it simply means selling and buying. So when you say long, the stock is undervalued. When you say short, the stock is overvalued. Okay? Now we go to our next subtopic, which is the major categories of equity valuation models. So for this first part of this two-part series, ang focus natin for this video would be the present value models, the dividend discount models, and we have the free cash flow models. Pero mas pagtutuunan natin ng pansin itong DDM or the dividend discount models, followed by the multiplier models and the asset-based valuation models. Now, according to a 2015 CFA study, marami sa mga analysts ang gumagamit ng market multiples approach, which is the multiplier models, followed by the discounted present value approach. So as you can see, they have 1,900 980 respondents. So 92.8% of those respondents answered they are using market multiples approach, and 78.8% said they are using the discounted present value. And then last, or rank 3 is 61.4%. It says they are using asset-based approach, and then real or options approach, then other approach. So basically, itong top 3, ayan, yan ang pag-uusapan natin for this particular topic. Yan. Although 2 parts siya, series. Kaya ako siya napili kasi yan ang pinaka-significant, no? Na kailangan nakaka-relate kayo pagka napag-uusapan yan. Probably pag nag-work na kayo. And also, you can use it in your day-to-day experience, or if you really have an intention of being a future stock investor. Okay? So, this is our focus, the present value models. Basically, present value models or discounted cash flow models, kasi meron din tayong free cash flow model. It estimates the intrinsic value as the present value of the expected future benefits or future cash inflow. Okay. Multiplier models are intrinsic value based on multiple of some fundamental value, and asset base is based on the value of assets and liabilities. Okay. So, the choice of the model depends on the availability of information and the analyst's confidence in the appropriateness of the model. So, ito yung nabanggit ko kanina. If the intrinsic value does not match the market value of a particular stock, so you have to make sure that the confidence of the analyst is really present. So, sometimes, hindi appropriate dun sa gusto mong sukatin na firm, yung kanyang stock, ano? Kasi hindi naman available lahat ng information at some point. So, generally, analysts will try to use more than one model. So, hindi lang isa, kundi probably dalawa. Combination of these 3 or 4 models. Okay, para lang mas accurate yung kanilang basis. O nga naman, para the more the merrier, no? Kapag hindi masyadong nagdi-deviate or hindi nag-change yung estimates, ibig sabihin tama yung intrinsic value na nakuha derived from various equity valuation models. Okay. So, now let's move on to our dividend discount model, or we call the DDM. So, I'm sure you are now starting to scratch your head because this is the point where we are going to start the computational part of our discussion. Okay? So, kung makikita ninyo, hindi naman nagkakalayo dun sa, since present value nga to, no, ang dividend discount model ay gumagamit ng present value concept. Kung makikita ninyo, this is the same formula of a present value equation. So, ang point lang ng present value model ay kinukuha natin yung present value ng future cash inflow ng asset na yon or ng stock na yon. That's why, ito yung itsura ng ating basic equation for a dividend discount model. So, kung titignan natin, the intrinsic value, so V at year 0, because you would want to look into the present value of the potential gains that you will be getting from that asset. That's why it's V sub 0, or the value at year 0, which is today. Okay, so we're gonna call that the intrinsic value. Now, D is the dividend, and R is your required rate of return. Okay, so kung mapapansin nyo, no, it's a dividend discount model. We are focusing on the dividend because the potential value that you will derive from this kind of investment sa stocks is actually dividends. The reason why passive investors choose stocks is because they receive dividends. So alam naman natin kapag mas malaki yung dividendo, no? Dividendo na nare-receive ng isang shareholder, mas okay sa kanya. Ibig sabihin, the performance of the firm is doing well. Why? Saan ba nadiderive ang dividends? Sa ano ba ang basis ng ating dividends? It's actually the retained earnings. And retained earnings is the cumulative net income. So, ibig sabihin, mas malaking net income, mas malaking retained earnings, at mas malaking retained earnings, mas maraming o mas malaking dividends ang pwedeng i-share or i-partake ng firm sa kanyang mga shareholders. Okay, so remember, ang ultimate goal ng finance is the maximization of the shareholders' wealth. So kaya naman, ang malaking factor kung bakit o paano natin binavalue ang isang stock ay ang kanyang kakayahang mag-generate ng dividends. That's why we derive value from the way that firms issue their dividends. Okay? So, maliwanag kung bakit po tayo nagfo-focus po sa dividends, ha? Kasi it's actually the best kumbaga, gauge or measurement sa tool to see how good the performance of a firm is. So, kapag wala siyang kakayahang mag-issue ng dividend, ibig sabihin the firm is not doing well in terms of its earnings potential. Okay. So, going back to our equation, intrinsic value is equal to your dividend at year 1 plus, okay, P means the price at the end of year 1 over 1 plus your rate of return raised to N. So, 1 is ito, T or N, ano? So, required rate of return on the, assumed to be paid at the end of the year. So, basically, just looking at this, it's just a 1-year intrinsic value computation. So, pagka in-expand natin itong equation na to, same goes D1 or your dividend over 1 plus rate of return raised to 1 plus the value of your stock at the end of year 1 over 1 plus your rate of return raised to 1. Okay, so let's make this, let's make this clear. When you use the dividend discount model, you have to make sure that the company has a history of dividend payments. Because there are startup companies, especially yung mga nagsisimula pa lang ng mga kumpanya, because they are trying to boost their earnings, hindi muna sila i-issue ng dividends. So, they focus on reinvestments. Ibig sabihin, ibinabalik nila sa operations ng firm yung kanilang naipon na retained earnings so that they could expand their operation, thus expanding their earnings potential. So, alam natin, itong dividend discount model is not appropriate for firms that are on their startup phase. Okay, yung mga nagsisimula pa lang. Okay, the dividend policy is clear and related to the earnings of the firm. So, makikita natin to dun sa management report, no, yung kanilang dividend policy. It should be clear and it should be related to the earnings of the firm. Third is, it's on the perspective of a minority shareholder. So, hindi po to pwede dun sa mga majority shareholder. It is only applicable on the perspective of a minority shareholder. Okay. So, since pinag-uusapan natin dito sa ating formula, yung required rate of return, I'm sure in your investment management class, pinag-usapan na yung risk and return discussion. So, let me just review the concept of required rate of return. And you can actually derive the required rate of return using the CAPM model. So, ito yung formula niya. Required rate of return is equal to your risk-free rate plus your beta multiplied by the difference of your market rate less your risk-free rate. So just imagine if you're using the DDM or you're using the dividend discount model, you know that your values is very much affected when it comes to the risk-free rate. Risk-free rate is the least, no. The rate of your treasury bonds, okay? The maximum. Yeah. No, minimum rate of your treasury bonds, and of course yung beta. Beta is the volatility of a particular stock in the market. So the more volatile a stock is, the higher the risk is. So mamaya, for the sake of those who are not able to grasp the idea of how to measure the required rate of return later, I will be inserting that in my discussion. But basically, if you define required rate of return, this is a return that the investor requires on an asset given its risk and market interest rates. So the minimum rate of return is necessary to attract investors to buy funds from a company. I am not going to discuss the entire concept of the required rate of return for this particular topic, but if you want to have a more detailed discussion on this, just open the risk and return lecture available on the YouTube channel. So mas doon ko po diniscuss kung anong ibig sabihin ng required rate of return. But because kasama siya dito sa ating formula, kaya ko lang siya in-insert. Now, let's go to our for our next part, no? We're gonna do actual computations. So let me just open my Excel sheet. Yan. So as you can see right here, I have selected just a few publicly listed firms here in the Philippines. What I did is kinuha ko yung kanilang dividend history from 2015, 2016, 2017, and 2018. And then I also included their current stock price, no? And this one, ako lang nag-compute nito, itong required rate of return. And then this one, yung beta nila, kinuha ko online. So, siguro para lang ma-share ko sa inyo, no, dun sa mga hindi ko students sa investment management class, although tapos na kami dito, we've already discussed this. Let me just share with you kung paano ko nakuha itong beta. Okay? Okay, so punta lang kayo ng Google. What I usually use is the investing.com website. So you just simply write the name of the firm that you would want to look into. So this one is Aboitiz Power Corporation. You just simply write beta because you're looking for the beta. Hindi mo makukompute yung beta hindi mo makukuha yung required rate of return without getting the beta information. That's why you have to put that in your Google search, and then you just simply write investing.com. Although there are a lot of websites such as Instagram, we have Market Trends, Market Watch, we have Yahoo Finance, we have the PSE. Napakaraming website that caters to different financial information of publicly listed firms. But for this discussion, I am using investing.com because it's very kompleto, Ricardos, nandun na lahat, no? Very comprehensive yung information na meron si investing.com. So you can see that meron siyang PH, investing.com PH, because actually investing.com is a global website, but the thing is, you would know that you are putting the right, or kumbaga, you're searching the right Filipino publicly listed firm kapag ka nakita mo na yung PH. So, pagka binuksan mo yan, ito yung lilitaw, So, there's Aboitiz Power Corporation. It's coming from the Philippines. Okay, so pagka din-drag down mo siya, you will see the technical analysis part of the firm. And then you will see the previous closing price, the opening price, volume, average volume, number of shares outstanding, price to earnings ratio. It's all in here, the total market capitalization. And then, of course, you will see the beta. Okay? Ayan po yung hinahanap nating information. It's here. And it says 0.54. Okay. So, pag tinranslate kasi natin yung beta, if the beta is 1, when the market is losing 1%, your stock could also lose 1%. But if the market is gaining 1%, your stock would also gain 1%. So, ibig sabihin kapag 1, yung beta mo, the volatility of that stock is moving similarly with the market. So, if it's less than 1, ibig sabihin, less volatile yung stock na tinitignan mo. If it's more than 1, you know that it's a high risk stock. So if the beta of a particular company is more than 1, it means it's more volatile. Hindi ibig sabihin volatile siya, it's a scary thing. You know, in finance, we have a concept of risk-return trade-off. The more volatile a stock is, the more risky it is, but it has more potential gains. Okay, now also there is SPC Power Corporation right here. No, yung kanyang beta is 0.12. So hindi pare-parehas ang beta ng iba-ibang stocks. So babalik ko. Okay, babalik tayo dito sa aking Excel sheet. So as you can see, the dividend history is also available in the investing.com website. If you would want to see the dividend history, nandun din po. You just wanna check that out. So ginawa ko itong list na to just so yung aking mga examples dito sa ating i-compute ay may basis naman kahit papaano, ano? And you're very much familiar with the firms para hindi naman hypothetical yung ating mga examples. So itong required rate of return ay kinompute ko na lang po ito. So as you can see, the PSEI market return right now is at 12%. I also searched that, ginugel din natin yung 12% na yan. And the risk-free rate right now is at 3.26%. Ibig sabihin, if you're gonna purchase a treasury bond, it's at least the highest would be 3.26%. So having said that, we can now compute for the required rate of return. No, the formula is your risk-free rate, which is 3.26%, plus your beta. Ito po yung beta natin per company. Iba-iba po yung beta natin. So insert mo lang yan. Multiplied by the difference of your market rate, which is 12%, less your risk-free rate. That's why I arrived with this number right here. So hindi ko po yan inimbento. It's based on actual market information at the moment, right? Okay? So as you can see, meron po akong formula dito. Dinrag ko lang yan. So therefore, automatic kukompute niya na itong different required rate of return per company. Okay, now punta muna tayo dito sa single period dividend discount model. Okay, now later we would be applying yung tinatawag nating value estimates. Now, as we compute for our intrinsic value, we would then be analyzing whether if it's undervalued, it's fairly valued, or overvalued yung stock. Okay, now here's the first problem. Aboitiz Power Corporation is expected to pay a dividend at the end of the year of 1.4. So again, ang basis ko dito is actual latest dividend payments ng Aboitiz, no, which is 1.4 peso per share. The analyst estimates that the required return to be 8%. So again, that rate of return is based on, tama ba? Is it based on my computation? Aboitiz? Yes, 8%. So I just rounded that off. It's 7.98. So it's 8%. And the expected price at the end of the year is 25.5 So the current price is 23.5. You have to calculate the value of the shares today and determine whether Aboitiz Power Corporation is overvalued, undervalued, or fairly valued. So using the formula that I've shown you a while ago, pakita natin. Okay, so you are going to get the value of your dividend at year 1 over 1 plus your rate of return raised to 1 plus the value of your stock at the end of year 1 over 1 plus your rate of return raised to 1. Now, going back to my slide, what we want to do is again, okay, ganito po So since I'm going to use the Excel sheet, so please observe carefully. If you want to do this manually, you can do it on your own. Just look into the formula and try to do it sa calculator. But for this particular discussion, I am going to use the Excel sheet. Okay, so equal sign lang po tayo. First is, okay, alright. So your dividend is 1.4. Okay. 1.4 plus the price at the end of the year. That's 25. 1.4 plus 25.50. Yeah. Divided by 1.08. Why 1.08? Because it's 1 plus the rate, so that's gonna be 8%, so that's gonna be 1.08. Okay, so since if ni-raise mo naman siya sa 1, you will just get the same answer, kaya hindi na natin ilalagay yun. Ayan. Okay, so actually kung makikita nyo kanina, yung formula natin is ganito siya. Right? So, kailangan D1 over 1 plus R divided by 1 plus R raised to 1 plus P1. So, nakita nyo, pinagsama ko na lang siya. You will get or you will derive the same answer kung if you wanna try that on your own, So, shortcut ko lang siya, but it's definitely the same. Pagka nilong cut natin yan dito, ganito ang magiging niyang sagot. Okay, D1 is, that's gonna be 1.4 divided by 1.08. Okay, and then for the V1, kasi ito yung value at year 1, hindi pa yan yung hindi pa yung intrinsic value natin. It's just your value of the stock price at the end of year 1, and that's 25.5 divided by 1.08. Okay. Ay, wala tayong equal sign. Equal sign, syempre. And then if you add that, yan palang yung intrinsic value natin, we're gonna get the sum of those present value prices. You will get 24.9 or 25. So, same lang po. Okay. Now, the question is, it overvalued, undervalued, or fairly valued? If it's currently selling at 23.5, question is it undervalued? Is it fairly valued or overvalued? So, balikan natin yung ating rule. If the intrinsic value is greater than the market price, lagi tayong mauuna dito sa intrinsic value. The basis is always the intrinsic value. Baka kasi nagkakabaliktad kayo, pinagbabaliktad nyo. Una nyong tinitignan is market price. Hindi po. So, palaging mauuna yung intrinsic value. Look into the intrinsic value first. The answer is 25. So, the question is it greater or less than the market value? So, if it's greater, if the intrinsic value is greater than the market price, mas mataas ba ang intrinsic value kesa dun sa current price? The answer is yes. It is. Mas malaki ang intrinsic value kesa dun sa market price. So, meaning, ang sagot natin dito ay siya ay undervalued. Okay? Kasi ang value niya talaga ay 25 pero binibenta lang siya ng 23.5. So the question is, will you buy it at 23.5? Of course. Kasi nakamura ka. Alright? Mas mura siya. Kaya undervalued siya. So here's the thing, when you use fundamental analysis and you complement it with technical analysis, we're gonna talk about technical analysis siguro mga a few weeks bago matapos yung SEM, hopefully nakalimutan ko na kung pang ilan na ba siya sa ating discussion, but anyway, technical analysis would support fundamental analysis. Why? Kapag ka nakita mo sa charts, the stock is selling at 19. Ayan, o kaya 20. That's the best time to buy because as computed, 25 yung intrinsic value but it's only selling at a lower price. Bilhin mo na because you're getting a discount from that price. That's what we call, you have to constantly look for cheap or undervalued stocks. Now, next po, we have another example here. URC is expected to pay a dividend at the end of the year of 1.65. So the analyst estimates that the required rate of return is 11.65%, and the expected price at the end of the year is 144. The current price is 133. Calculate the value of the shares today and determine whether URC is overvalued, undervalued, or fairly valued. So, using the same technique, whether you would want to do it this way para mas sigurado ka. Okay, so your D1 value at year 1 and your intrinsic value. So, your D1 is equal to 1.65 divided by 1.165. Inad ko na po siya, 1 plus R. So, 1.11 dapat pala. 1.1165. And equal 144 divided by 1.1165. Then you get the total of that 2. Your answer is 130.45. Okay, so is it overvalued or undervalued, or is it fairly valued? The current price is 133. Again, same scenario dito, no? Okay. Current price is right, it's 133 in the market. Alright, it's, ulitin natin the intrinsic value, is it more than? Sorry nalito na tuloy ako. If the intrinsic value is 130, is it greater or less than? Okay, so ang answer natin, it's less than the market price. So, ibig sabihin, the current market price is overvalued. Masyado siyang mahal. Kasi ang presyo niya lang talaga is 130. Pero binibenta siya at 133. So, it is overvalued. So, sabi natin kanina, if overvalued yung stock mo, the investment decision there is to sell. Oo nga naman. Kasi 130 lang talaga yung value niya. But the market is willing to buy it at 133. Okay? So, ang answer natin dito ay 130.45. This is overvalued. Okay? Right? Current price is 133, but the intrinsic value is only 130.45. Ba ayaw niya? Yan, 130.45. And last natin na, this is gonna be our last example for the single period dividend discount model. Okay, so Petron Corporation is expected to pay a dividend at the end of the year at 0.20. The analyst estimates that the required rate of return is 12.17 and the expected price at the end of the year is 3.8. And the current price is 3.06. Now, we have to calculate the value of the shares. Sige. So, our dividend at year 1, value at year 1, and of course, intrinsic value equals 0.2 divided by 1.1217. Then equals 3.8 divided by 1.1217. Then get the sum of these two. You'll get 3.57 to be exact. So 3.57 versus right now it's selling at 3.8. If it's sorry, asa na ba yung selling? Current price is 3.06. So you know that this is an undervalued stock. Kasi 3.57 but it's only selling at 3.06. You are expecting that the price would eventually match the intrinsic value. So, you will get gains. Ito yun eh. Magkakaroon ka ng gains. Pag binili mo siya 3.6, tataas pa siya at 3.57. Syempre, ultimately, you would create gains for that particular stock. Okay, I hope you understand the basics. No? This is just a single period dividend discount model. Now that you know how to compute for the single period DDM, you can now easily understand 2-period DDM and actually isama na natin yung multiple period DDM because the concept is just the same. The only difference is, yung isa is 2-period, ibig sabihin 2 years, and this one is multi-period or multiple years. So, balikan natin yung ating Excel sheet kanina. And using the concept, yung kanina, you just simply have to get the present value of each of the dividends each year, and then you have to add the value, the estimated value of your stock price at the end of the period. Okay, so in this case, it's San Miguel Food and Beverage Corporation, and the dividends is 0.6 and 0.95 at the end of each of the next 2 years, respectively. So the investors expect the price of the shares at the end of this 2-year holding period to be 75 pesos. So the investor's required rate of return is 12.52%. You have to calculate the current value of the share. So again, using the same concept, hindi mo na kailangan pang tignan siguro yung formula, mas madali kasi siyang i-explain dito sa Excel, no? First is you just have to get your dividend at the end of the first year. The rate is 12.52, so that's gonna be 1.1252 divided by that. Okay, next is your dividend at year 2. Okay, so again, same concept with the present value. I-raise lang natin siya into 2 because it's the second year. So that would be D2, 0.95 divided by 1.1252 raised to 2. And then your value at year 2, that's going to be your P2. So 75 divided by 1.1252, again, raised to 2. And then simply drag everything, kunin yung total. Okay, so the answer is 60.52. That's the San Miguel Food and Beverage Corporation intrinsic value right now. So if San Miguel Food Corporation is selling at 59.05 today, okay, so the selling price is 59 and we have calculated that it's 60.5. Hindi siya nagkakalayo. Pwede nating sabihin kasi pagka ni-round off natin to, it's still 60. If we round off this, it's 60.5, pero hindi masyado nagkakalayo. So, pwede nating sabihin, it's fairly valued, hindi naman na masyadong malayo. Ano? But since it's a bit higher, pwede nating sabihin, ano pa rin siya, overvalued ng konti. But, well, we can say it's relatively close to the current market price, ano? So we can probably say it's fairly valued. Pwede na, malapit naman eh. Okay. Minsan ano na rin, discretion na rin ng analyst if gusto niyang i-consider as fairly or undervalued. But for me, in my judgment, since 60 pa rin naman yan, it's, for me, it's already fairly valued. Hindi na masyadong masama, ano? Here sa Phoenix naman, it's expected to pay dividends of 0.1 and 0.15 at the end of the next 2 years respectively. The investors expect that the price of the shares at the end of this 2-year holding period would be 16 pesos. So the investors' required rate of return is 8.94. Calculate the current value of this share. Again, same principle, you have the D1, D2, V2, and then V0. Okay, D1 is equal to this, divided by 1.0894. Okay, equal to this, divided by 1.0894 raised to 2. And then this one, 16. Price at the end of the 2-year holding period divided by 1.0894 divided by 2. Right? And then just get the total amount. Total value, you'll get 13.7. So currently, it is selling at, let's see kung magkano yung selling price niya right now. Ano ba yun? Ano ba yung ano natin? Phoenix. It's Phoenix. Ayan. 11.28. It's selling at 11.28, but the intrinsic value is 13.7. So meaning it is undervalued. Okay. Undervalued because the intrinsic value is greater than the market price. Again, tignan mo, it's 13.7 and this is 11.28. Okay, so murang-mura siya sa market. Okay, I think at this point, actually, hindi na kailangan tignan pa yung formula natin dyan because it's just the same. So let's now move on to, I just inserted one example because I think at this point gets nyo na kung paano siya kinukompute, ano? So kahit ilang years pa yan, whether it's 5 years, 10 years, you will get the answer ng napakadali lang naman. Very, very, very easy. Although yung mga analysts natin, they're already doing it in a faster way, but I'm just showing it to you paano siya ginagawa step by step so that you can fully appreciate the process of the present value model. Okay, so for D1 equal sign, hindi pa pala binasa, no? So SPC Power Corporation are expected to pay dividends of 0.4, 0.7, and 0.40 at the end of each of the next 3 years. Okay, respectively. So the investors expects that the price of the shares at the end of this 3-year holding period to be 17.5. So the investors' required rate of return is 4.4. Calculate the current value of SPC Power Corporation. For those of you asking, ma'am, paano ba nadiderive ng mga analyst ito? It's because nagkakaroon din ng 5-year projections para yung ginagawa ninyo sa feasibility study. They publicly listed firms also create 5-year financial projections, and when they do, syempre, kasama na dun yung dividend estimates, yung earnings estimate. And so, everything else follows. Kasi kailangan yun for projection purposes, for forecasting purposes. Okay, so D1 is equal to 0.4 divided by our required rate of return is 4.4. So that's going to be 1.044. Okay. Next is we have 0.70 divided by 1.044 raised to 2. D3 is 1.044 raised to 3. And 17.5 divided by 1.044 raised to 3. 3. Alright, tapos drag lang natin. Total. So the answer is 16.76. Okay. 16.76. Right now, SPC Power Corporation is selling at 10.46. So if that's the case, 10.46 siya binibenta ngayon, but it's 16.76. Napakalayo. Ito talaga yung masasabi mo, oh, ang mura ng bentahan sa market ngayon, So this is undervalued. Okay, so syempre, dahil nga 3 years yung projection natin, talagang mas malaki yung difference niya, yung gap, kumbaga. That's why it's good to purchase stocks today rather than next year or in the next 2 years. Mas okay na bumili ng stocks today because time is of the essence. Kapag ka finance ang pinag-uusapan, pagka interest pinag-uusapan, pagka pera pinag-uusapan, time is the best investment. So the earlier you invest, the better. Okay, and now for our next subtopic, we're gonna talk about the Gordon growth model. So ibang naman to ha. Ibang formula naman to, ibang assumption. So makinig kayong mabuti. Sa Gordon growth model, it is assumed that dividends are the correct metric to use for valuation purposes. Yan. Sinabi niya talaga, it's the correct metric. There is no other way to measure the value of a stock but through dividends. Yes. The dividend growth rate is forever. Okay, it is perpetual and it never changes. The required rate of return is also constant over time. The dividend growth rate is strictly less than the required rate of return. Ito yung mga premise na tinatawag natin o mga kondisyon. You can only apply this model if you are assuming that the dividends are really the correct metric to use for valuation purposes. If the company that you are evaluating has a constant growth rate in terms of its dividends, ibig sabihin, na-reach na ng company na to yung kanyang maturity period dahil constant na yung kanyang growth rate. Ibig sabihin, hindi na pumapalya yung kanyang pag-increase ng earnings niya, no? Kasi yung growth rate is perpetual. Pag sinabi mong perpetual, forever at hindi na magbabago. And next, the required rate of return for that particular stock would be constant over time. Hindi na volatile. So, applicable po ito talaga sa mga highly established firms. But right now, we are having a pandemic. I'm sure the Gordon growth model would not apply to most of the stocks that you would want to value right now. Kasi Gordon growth model can only be used if the required rate of return is constant over time. And then, of course, the dividend growth rate is strictly less than the required rate of return. So, hindi pwedeng mas mataas yung growth rate kesa sa required rate of return. So, ito ay ina-apply lamang. This is strictly applied and appropriate for stable, mature dividend paying firms. So hindi po ito pwede sa mga startups, hindi po ito pwede sa mga nasa growth stage pa lang. We only apply Gordon growth model for highly established and mature dividend paying firms. It's also used for valuing market indices. It is very easily communicated and explained, and it determine price implied growth rates, required rate of returns, and value of growth opportunities. And it can be used to supplement other complex valuation models. So, hindi lahat pwedeng gamitan ng Gordon growth model. But for the sake of discussion, let's look into the formula of the Gordon growth model. Kasi madalas ito yung mga tinatanong sa quiz bee, ganyan. So, kailangan alam mo rin yung, yung formula. And if you're planning to, to take the CFA exam, actually, itong material ko is kinuha ko sa level 2. Oh, level 2 CFA exam na po ito kung itatanong nyo. Pero I just use the simpler examples for you to understand it. So anyway, using the Gordon growth model, you will derive the intrinsic value using the recently paid dividends multiplied by 1 plus the dividend growth rate, okay, constant dividend growth rate, over your required rate of return minus your growth rate. Okay, so if we're gonna apply that, we have a problem right here. Okay, the Gordon growth model. Zoom natin konti para mas malaki. Ayan. Okay. Okay. So, meron tayong problem dito. 3MMM Inc. recently paid a dividend of 1.3 to its shareholders. An analyst has examined the financial statements and historical dividend policy of 3MMM. And the firm's dividend rate will grow at a constant rate of 3.5% indefinitely. Okay, sa mga problems na mababasa ninyo, whenever you see the word constant, whenever you see the word indefinitely, it means it is very synonymous with the word perpetual or forever. Diba? Sa finance may forever po. Oo. So, ayan. Alam niyo na ang gagamitin yung formula, if this is the case, it's always the Gordon growth model. Because analysts are assuming that this stock will have a constant dividend growth of this amount or this percent or this rate. Okay? The problem with this, question, hindi ibinigay yung ating required rate of return. So, kailangan kasama dun sa ating problem na i-compute muna yung ating required rate of return. Okay. So, if that's the case, kung hindi outright given sa problem, kailangan mo muna siyang i-compute. Okay? So, kaya dito nilagay ko, step 1, calculate the required rate of return using the CAPM model. So, the beta is 1.5. The risk-free rate is 4%. The market return is 8%. Now, compute for the required rate of return. So, sige. Para ma-review tayo, i-copy ko na lang tong ating formula so that pag nag-review kayo, pwede nyo tong balikan. Okay? I-paste ko na lang dito. Anyway, very simple lang naman yung formula. It's just your risk-free rate equals sign your risk-free rate plus, okay, beta is 1.5 multiplied by, so kailangan dalawa yung ating parenthesis dito. Okay? Kasi meron ka pang isang parenthesis dito. Market rate, which is 8% minus the risk-free rate, which is 4%. And then, isa pang kulong. Ayan. Ay, kulang pa ba? Ba't hindi siya nag-block? Ayan, isa pang kulong. Iga-guide ka naman niya eh. Iga-guide ka ng Excel kung kulang o sobra ba yung parenthesis mo. Ayan, so the answer is 10%. Now, since we have now our required rate of return. Pwede na nating computein yung ating intrinsic value using the... meron naman pala dito. Kinopya ko pa, meron pala. We can now use the formula of the Gordon growth model, which is, balikan natin, your dividend, your latest dividends multiplied by 1 plus your growth rate. Okay, unahin natin yan. Dividends multiplied by 1 plus growth. Okay. Equals your dividend, which is 1.3 multiplied by your 1 plus the growth rate, which is 3.5. Okay. Divided by, I think I need kailangan natin ng isa pang ano dyan. Para hindi magkamali yung Excel sa operations natin, ano? Kasi, pagka mali na yung ano mo, pagka nagkamali ka na ng parenthesis dyan, di niya na alam ano yung minumultiply niya. Kaya ako, very generous ako dyan sa mga parenthesis ko. Okay. Divided by your rate of return, which is 10%. Minus your growth rate, which is 3.5. Okay. So, para lang sure ako, what I'm gonna do, since these are two, since fraction siya, gagawin ko, papaluputin ko pa siya ng isa pang, dito. Ayan. So, parang buo siyang operation yan. So, the answer is 20.7. Okay? If my computation is incorrect, please let me know. Kung gumagamit ka ng calculator ngayon. But let's double check if my answer is correct. It's multiply. Wala naman siyang wala namang exponent. So ganun lang siya. 1 plus g. Okay, let me check again. Minsan kasi baka nakakatakot, baka yung mga mo mali-mali pala, no? Mali-mali yung nagagawa ng Excel dahil sa dami ng parentheses. Okay, okay, dividends multiplied by your growth rate. Okay, 1 plus G. Ayan. Okay. So, lagyan pa natin ng isa pang parentheses. Divided by, ang simple lang ng equation. R minus G. Okay. So, again, hindi applicable ang Gordon growth model pagka yung required rate of return kapag ka yung dividend growth rate mo is higher than the required rate of return. Kailangan palaging mas mataas yung required rate of return mo. Okay, tingnan natin kung tama. Kasi kanina nilagyan ko pa ng extra parenthesis eh. Okay, so tama naman. 20.70. Ayan. So, that's the correct answer. 20.7 ang intrinsic value of this particular problem. Okay, next. Fork Shop Industries issued dividends worth 0.9 a share. So, after a careful analysis, the firm's dividend is projected to have a stable and constant rate of 2.8% perpetually. So, the rate of return for this stock is assumed to be 8.5%. What is the value of the stock? So, kung mapapansin nyo, before ako nagsosolve ng problem, sinusulat ko muna yung ating mga given. Okay? So, yung ating dividend at the moment is 0.9. Our constant growth rate would be 2.8%. And the required rate of return is 8.5%. Kasi ayokong magkamali sa intindi ko ng problem. That's why sinusulat ko muna yung mga requirements. Okay? So, for the intrinsic value, okay, equals your dividend multiplied by 1 plus your growth rate, 2.8. Okay, sa pangkulong. Right? Divided by your required rate of return, minus growth rate. Okay. Ayan, para sure lang. Kasi gusto ko talaga nagkukulong ng parentheses. Answer would be 16.23. So that is the intrinsic value. That would be the share price of this particular stock. So hindi naman nakasulat dito sa problem kung magkano yung current stock price niya. So yun na yun. Kung hindi naman nakasulat dun sa problem, yung kanyang stock price, hindi mo naman kailangang i-identify whether it's overvalued or undervalued. So as it is lang po tayo, 16.23. But what if, no? What if the current stock price, let's just say right now, is at 22 pesos? Ayan. Diyan mo malalaman. Pag sinabi na ng problem, the current stock price is at 22 pesos. So, is the intrinsic value overvalued or undervalued? So, if that's the case, 16.23, yung ating intrinsic value, market price is 22, you know that this market price is overvalued. Kasi nga, 16.23 lang, pero binibenta siya ng 22. So, it's overvalued. Okay, next na po tayo. After the Gordon growth model, we have the two-stage dividend discount model. Okay, kung kanina meron tayong two-period, this time it's a two-stage. So, ibig sabihin, meron palang stages of growth yung ating mga firms na ini-evaluate. So, sometimes, actually, meron tayong tatlo. Hindi ko na nga lang kinuha yung isa. Yung isa ay 2-stage, yung isa ay 3-stage. Meron din naman yung, tawag dito, it forms like an H. Kaya H yung tawag sa kanya. No? Parang, yung formation ng kanyang figure is letter H. But anyway, hindi ko na in-include yun. It's just the 2-stage and the 3-stage DDM. It simply means at the first part of the firm's life, napakataas nung kanyang dividend growth. But once nag-mature na yung firm na yan, it's gonna have a constant growth on its next stage. So, on the latter part of the existence of that firm, no, constant na yung kanyang growth. But on the first stage na napakataas, it's at 15%. But on stage 2, as time goes by, no, nagiging na siyang 3% constantly or in perpetual na yung kanyang growth rate. So, yung 3-stage naman, literally, tatlo. So, from 25, 15, and then finally, 3. Okay, this is on the year 8 and this is on the year 3. So, tignan natin kung bakit kailangan bang i-take into consideration yung tinatawag nating long run or ang tawag natin dito ay phase. Ba pinahirapan yung sarili ko, no? Phases of the earnings growth potential of a particular firm. So, sa initial stage daw, mataas or rapid yung pagtaas ng earnings. Kasi pa yan startup, nagsisimula pa, wala pa masyadong competition, ganyan, no? Mas aggressive pa sa market. So, tendency, wala pang dividend payments yan. Kasi nga, it's heavy on reinvestments. Ibinabalik pa yung earnings ng kumpanya sa loob ng operations at nililimitahan pa yung pag-i-issue ng dividends. So, on the transitioning stage, no, earnings and dividends are still increasing although bumabagal yung rate ng earnings or hindi na ganun kataas yung rate ng earnings because pumapasok na dyan yung competitive forces or alam nyo naman kapag merong isang nagtinda, gusto ng lahat magtitinda na lahat. So, ganung concept, dumarami yung competition as time goes by. And then, sa mature stage naman, earnings grow at a stable but slower rate. So, hindi na ganun kataas yung pagtaas ng growth rate kasi na-reach niya na yung highest potential niya. Nandun pa rin, nag-grow pa rin, but hindi na ganun kabilis as compared to the initial stage. And of course, payout ratios are stabilizing. Ibig sabihin, mas generous na sa pag-i-issue ng dividends yung firm kasi stable na yung kanyang earnings potential. Ayan. Okay, so pagka tinignan mo yan sa graph, it looks like this. So, dun sa introduction stage mo, nagsisimula pa lang, kukunti pa lang earnings. And then from there, as you go to your growth stage, to your maturity stage, and then decline stage. So, ganun, kapag visualize natin siya, ganun ang itsura niya. So, if you're gonna actually try to analyze, ang maganda dito, pinapakita, although I got this resource from the CFA review material, okay, asa na ba yun? Okay, if you just wanna, saan ba nakita yung hindi siya ito. Okay, anyway, this table would show that the different phases of a firm's earning potential, no? During the initial stage, very high yung kanyang earnings growth. Yung capital investment ay napakataas ng requirements. Yung profit margin is mataas kasi wala pang masyadong competition dyan eh. Yung free cash flow, free cash flow is negative because mas mataas ang expenses or expenditures. So, negative yan. ROE versus required return, no? Mas malaki yung ROE kesa sa required rate of return kasi nga yung earnings potential niya ay napakataas. Dividend payout is low or zero. Wala pa talagang dividend na dinidistribute. So, habang tumatagal, nagkakaroon ng, at least, this table will actually give you an idea if anong klase ng discount model yung gagamitin mo. So, habang nagsisimula pa yan, ang gagamitin mo dito is yung 3-stage. Doon sa kalagitnaan, magiging 2-stage, and then later on, dun sa maturity period, Gordon growth model na yung gagamitin. So, just to give you an idea kung kailan talaga ba ginagamit yung iba-ibang models natin ng dividend discount model. Okay. So, as you can see, dito sa 2-stage DDM, napaka-complicated naman ng ating formula, no? Kasi kung titignan natin yung graph natin kanina, dito sa 2-stage, from 15%, magiging siyang 3%. Okay? Kaya dito sa formula, we have a short-term growth rate. Okay? Ito yon, GS. So we're just gonna simply add all of the dividends plus 1 plus the short-term growth rate divided by 1 plus the required rate of return. And then the ending, ito yung V, kunwari, kung 6 years yan, no? Or 5 years. Ito yung kinukompute natin na V5. Ito yung ending, ibang tawag dito is yung terminal value na kinukompute natin, ano? So, the formula would then be the current dividend that was issued multiplied by 1 plus the short-term growth raised to n multiplied by 1 plus your long-term growth. So dito in this case, it's 15%. Ito yung short-term growth natin. And this is going to be the long-term growth which is 3%. Okay, over 1 plus your required rate of return raised to n multiplied by r minus your long-term growth. So, kahit papaano, kung titignan mo, no, na-adapt pa rin yung Gordon growth model. Doon pa rin nag-base yung formula na ito. Actually, ito, doon sa multiple period DDM. And then this one is, it's a mixture of the Gordon growth model. So, again, you are doing this process simply because nga hindi nga constant yung dividend or yung earnings phase ng mga companies, no, na meron silang mga ganitong transition. That's why you have to make sure that the model that you're adopting is really suitable to the type of firm that you are evaluating. Okay, para lang mas maliwanag sa atin, okay, tignan natin yung ating problem dito. It's a two-stage model. Nako, inano ko na ba? Two-stage. Yeah, okay. So, sabi niya, Sea Island Recreation. Sige, wag ko na munang burahin. Basahin ko muna. Okay. So, Sea Island Recreation currently pays a dividend. Zoom natin konti. Okay. Sea Island Recreation currently pays a dividend of $1. So, an analyst forecasts growth of 10% for the next 3 years, followed by 4% growth in perpetuity. Pero for some, it's pronounced as perpetuity. Yan. Ako kasi kaya perpetuity. But it's perpetuity. Yan. Thereafter. The required return is 12%. Calculate the value per share. So, kung gagawa tayo ng timeline, ito yung timeline natin, just for you to visualize the problem. Okay? So, on the first 3 years daw, sabi niya, 10% yung required, yung kanyang growth, dividend growth is 10% in the first 3 years dahil ito yung pinaka-aggressive stage na, it's 10% on the first 3 years, and then after that would be 4%, and then there's an infinity sign at the top. Ayan. So, having said that, we are just going to apply the concept of what we have been doing dun sa ating single period, 2 period, and then the multi-period DDM concept. So, as you can see right here, no, yung calculation niya is 1 because that is the D0 or the last issued dividend. That's 1 multiplied by the growth rate of the short-term growth rate pala. Sorry. Multiplied by the short-term growth rate, which is 10%, divided by 1 plus your R, which is 1.12. So, kapag kinumpute natin yan, ito yung formula sa Excel, no? 1 multiplied by 1.1 divided by 1.12, you will get this answer. And on the second year, that's gonna be 1 multiplied by 1.1 raised to 2 divided by 1.12 raised to 2. Kasi nga, on the second year na. So, I hope you're following, ano? And then, on the third year, we're still valuing the dividends, ha? Wala pa tayo dun sa, dun sa last part. Kasi sabi niya, on the next 3 years. And then, after that, it's gonna be 4%. Okay. So, on the third year, 1 multiplied by 1.1 raised to 3 divided by 1.12 raised to 3, you will get this answer. Now, here's the messy part. Kasi kung babalikan natin itong formula natin, it is your dividend multiplied by 1 plus your, 1 plus your short-term growth rate raised to n. So, in this case, we have 3 multiplied by 1 plus your long-term growth rate divided by 1 plus r raised to n multiplied by your required rate of return minus your long-term growth. So, you have to apply this equation to your Excel sheet. Again, if you want to do this manually, you may do so. Walang problema. But I am just gonna discuss it using the Excel. So, again, 1, yung dividend mo is 1 multiplied by your short-term growth rate raised to n, which is 3 years, times your short-term multiplied by your long-term growth rate divided by 1 plus required rate of return raised to 3 or n multiplied by the difference of your required rate of return minus your growth rate. Ayan. So, yan ang bakit ba dyan ko tinitignan mas maliit? Ito pala yung mas malaki. Ayan. Okay. Pagka nagawa nyo na yan, once na input nyo na yan, okay, mabilis lang kasi pagka sa Excel, pag sa calculator, medyo mas matagal pumindot. So anyway, whichever you're comfortable, walang problema sa akin. So once you already key in your equation, you will get this answer. Okay? Siguro dito sa Excel, konting practice lang sa paglalagay ng mga you have to make sure correct yung mga parentheses that you are inserting or else mali yung or ibang sagot ang maibibigay sa'yo ni Excel. So practice lang. Hindi mo to pwedeng ipaturo sa iba. It's really up to you kung paano mo makukuha yung yung operations natin through using parentheses. Anyway, after getting all of these present values in place, okay, ang gagawin mo lang, parang kanina, i-add mo lang lahat. Summation lang po tayo. So, you'll get 15.21. I know the process is very somehow complicated, but what you have to do is really try to practice it, try to answer other problems that are available online or in your exercises. So kapag mas maraming beses mo na siya nagagawa, ibig sabihin mas nagiging komportable ka na dun sa proseso. But at first, I know right now kasi first time yung makita, medyo mahaba yung proseso, but it takes practice and it takes a lot of determination para makabisado mo yung proseso ng pagko-compute ng intrinsic value using the two-stage model. Now, let's proceed to the three-stage model. Actually, ito, nilagay ko na lang dito sa aking PowerPoint in case you would want to look into yung anong tawag dito, yung long cut, kapag kinumpute mo to mano-mano, ganito ang itsura. But if you try to compute it sa Excel, mas mabilis. So just imagine gaano kahaba yung formula pag iniisa-isa mo, So this is gonna be on the first year, this is on the second year, third year, and then finally, this is the V3. Ito yung kinukompute natin ng mas mahaba. This is how the equation looks like. So you're gonna save a lot of time if sa Excel mo siya gagawin. Ayan, nakaka-overwhelm, ang daming numbers. But anyway, it's fun to do something that you haven't done before. So since first time naman ninyo siyang gagawin, might as well enjoy the process of learning something new. Okay. Next naman is yung tinatawag nating three-stage. Saan ba yung three-stage natin? Bakit wala siya? Okay. Sa three-stage naman, hindi ko na nilagay dito yung formula, but pinakita ko na lang dito yung answer natin. But technically it's just the same. Okay? But of course, we have a different formula for the three-stage DDM. Kasi itong formula na to is exclusively for a two-stage DDM. Okay? This is exclusively for a two-stage DDM problem. But if it's a three-stage DDM, the formula for the last kumbaga ito V6 kasi 6 years ang hinahanap, Siguro pakita ko na lang para alam natin yung sinasabi ko, no? So this equation right here would not be the same with the two-stage DDM. Okay? So hindi na siya ganito kahaba. Sa three-stage DDM, what you're gonna do is the last dividend basis multiplied by the growth rate divided by your, kumbaga ito Gordon growth formula which is the required rate of return minus the growth rate. Okay, so no need for the long equation as compared to the two-stage DDM. So mas maiksi na yung dito sa last portion ng kanyang valuation. Okay? So ipakita ko lang siya kung paano na-derive sa sa Excel. Kasi kailangan natin mag-compute ng net present value. Okay. So, as you can see, kung babasahin muna natin yung problem, hindi ko na kasi pinakita yung equation. I went straight to the computation part. But anyway, let's just first read the problem para mas ma-imagine natin siya. So, R&M has a current dividend of $1 and a required rate of return of 12%. A dividend growth rate of 15% is projected for the next 2 years, followed by a 10% growth rate for the next 4 years before settling down to a constant 4% growth rate thereafter. So kung i-imaginein mo siya, gagawa tayo ng timeline, it's gonna look like this. So on the first 2 years, the dividend growth rate would be 15%. And then on the next coming 4 years, which is 3, 4, 5, 6, it's gonna be 10%. After that, infinitely, it's gonna be 4%. So mag-change tayo ng growth rate 3 times. That's why it's called the 3-stage dividend discount model. So pagka ginawa natin siya, using the concept of yung multi-period DDM natin, it's gonna look like this. Okay? So on the first year, that's gonna be 1 multiplied by 1.15 because this is the dividend value at the end of the first year. Right? And on the second year, kung makikita nyo naka-carry over, kasi yan yung nangyayari kapag ka nagko-compound ka. So, same concept ng compounding, you get the latest basis of your dividend, which is 1.15, multiplied by 1.15 because that is the growth rate, you will get 1.32. Right? And on the third year, ito na yung magta-transition siya from 15% to 10%. That's why nag-change na siya ng 1.32 multiplied by 1.10. So you'll get 1.45. And then carry over again, 1.45 multiplied by 1.10. It's going to be 1.6 on the fourth year. And then the dividend at the fifth year, it's going to be 1.6 multiplied by 1.10. You'll get 1.76. Okay. Now, on the sixth year, dalawa kasi yung mini-measure natin, di ba? The first one is the dividend, and the second is yung ating formula dito sa dulo, kumbaga ito. Isa for the dividend, one for the constant rate. Okay? Kaya dalawa tong ating bracket dito. So parang yun yung mini-measure natin. But technically, it's just the same the same year. Okay? So for the sixth year, that's gonna be 1.76 multiplied by 1.10. Okay? So the answer is 1.94. Okay. Now, for the last equation, yung huling equation natin, yung terminal value na natin kasi before tayo magkaroon ng constant growth. Okay? So that would be 1.94 multiplied by 1.04, which is your constant growth rate, divided by your required rate of return less your growth rate. So yun lang yung kanyang formula. Alright? So, usually, yung ginagawa natin, we usually drag this down and then we get the total. That's what we usually do. But for the three-stage dividend discount model, we are going to compute for the net present value. Net present value is, actually to tinuturo ko to sa strategic financial management subject ko, But anyway, if in-explain ko pa yung net present value, baka tumagal pa tayo. But anyway, ayan, basahin na lang natin yung definition coming from Investopedia, net present value is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. So NPV is used in capital budgeting. That's why I usually teach this strategic financial management, and investment planning to analyze the profitability of a projected investment or project. Okay, so the net present value formula, okay, pakita natin yung net present value formula natin. Okay. Ang tamad ko, dito ko na lang talaga siya, ito na lang talaga yung tinignan ko. Okay, asan na ba yun? Okay. Oh my gosh. Ayan. Just to show you kung paano yung net present value. The difference sa present value kasi is at year 0, dinidiscount yung initial cash outflow. Yun lang pinagkaiba niya sa present value formula. So, net present value considers the initial cash outflow. Alright. So, anyway, having said that, ang daming pinuntahan, napunta pa sa net present value. Oo, kasi hinahanap ko rin yung kanyang yung formula niya, talagang net present value yung itinuturo sa akin kahit saan ako magpunta, Anyway, ang net present value naman ay available dito sa Excel. So, you just simply have to type NPV, tapos lilitaw na yung formula. Ayan, lilitaw siya na ganyan. NPV. So, open parenthesis, the rate that we would be using is 12%. Okay, 12%. And then, don't forget to use comma. And then, isa-isahin lang natin from year 1 to year 6 yung ating mga present value, or we call this the cash flows kasi We call them the cash flows. So, 1.15, 1.32, 1.45, 1.6. This is for year 4. And then for year 5, it's 1.76. For year 6, kung makikita nyo, we have two values on the 6th year. One is for the dividend and one is for the terminal value. Kaya ang ginawa ko, in-add ko na siya dito on the side. Kaya meron kayo makikitang 27.16 dito. And then, close parenthesis lang tayo. Si Excel na ang magkukompute on its own. That's why you will get $18.88. So, the intrinsic value of a 3-stage model, kung 3 beses magpapalit yung kanyang dividend growth rate sa problem, ito yung formula na gagamitin. So, dito lang naman sa medyo matrabaho nga lang siya kasi nagki-carry forward ka nung balance nung dividend, But then again, like I said, I know it's a very meticulous process, but it takes time, it takes practice for you to get used to it. What we wanna just show is the entire process, paano siya nakukuha. Pero you know what, the moment you finally understand the entire process, yung mga ibang problem sa inyo mani-mani na lang. Pero ang importante dito, naiintindihan natin siya kung bakit natin siya kailangan gawin. Okay? So, answer is 18.88. Hindi po tayo gagamit ng summation po ha. Ang gagamitin natin is formula ng net present value kapag 3-stage model. Okay? Pero kapag ka 2-stage model, summation lang. Gordon growth model, walang problema, easy. Okay. And I think we're on to our last valuation model for under the dividend discount model or under the present value model. And this is calculating the value of perpetual preferred or preferred shares. So, napaka-simple lang, no? This, kita nyo na, ito, easy na lang to sa inyo eh. So, the value of the preferred share is equal to the preferred dividend over the cost of preferred equity. So, again, ang difference ng common stock sa preferred stock is that, unang-una, si preferred stock, fix yung kanyang return. So, it's just like a bond. Fix yung kanyang rate ng dividend. So, kung magkano lang yung sinabi na rate at the beginning of the period hanggang sa mag-expire yung share mo hanggat kung kailan mo siya gustong hawakan, it's gonna be a constant preferred share rate. Okay? So, applicable lang siya if perpetual at saka fix yung rate ng preferred shares. So, tignan natin yung problem dito so that we can understand what we are actually saying. Okay, so Exco has a fixed rate perpetual preferred stock outstanding with a dividend of 6% based on an issue of par of 300 pesos. So, if the investor's required rate of return for holding these shares is 9.5%, what is the current value of these shares? So, basically, the first thing that you have to do is get the preferred dividends. So, it's gonna be 6% of that 300. Okay, so ang D natin is 18. So, how do you get that? 300 multiplied by 6%. And then, finally, using the formula, D or the dividends divided by the cost of the preferred equity. No? Ang ating required rate of return is 9.5. So, simply 18 divided by 9.5%, you will get 189.47. So, this is the intrinsic value of this perpetual preferred stock. Alright, so that's the end of the first part of our topic under equity valuation models. I know it's a lengthy discussion. Dito pa lang naubos na yung oras natin. Hindi naman naubos. Kumbaga parang dami nating kinonsume na time. Oo, kasi masyadong, hindi naman siya ganun ka-complicated, but very, very detailed. So, ayan. For the next part, we're gonna talk about the multiplier models and the asset-based valuation model. Siguro, konting practice, and then if you have to replay the video again, please do so. So I'll see you on the second part of our equity valuation topic.